CNBC-TV18, our morning call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Thursday morning. I'm Prashant, with me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning. Morning, Nigel.
Morning.
Lots to reckon with this morning. The tide is perhaps turning for new age tech companies. The US markets have been on the weaker side. Disney is laying off in a big way, right? Over 7,000 employees. So much ground to cover today.
You know, despite all these juicy headlines of large companies laying off, you look at the labor market data which we got, right? And that kind of tells you that the tech proportion, and it's interesting data, that the number of tech employees in the US is a tiny fraction. You know, tech slash communications, internet, etc. All of that combined, I think it's about 1% of the US labor force. So, you know, sometimes it's jarring, right? You get all these headlines that companies are laying off, but, you know, the overall aggregate numbers are pretty strong. All right, let's just quickly run you through the setup this morning. You know, this is something we would we should have anticipated yesterday. It's a classic second day flip-flop. You know, day before yesterday, yesterday morning we highlighted the day before action, and it was a hugely volatile day. The market basically could not make up its mind. It rallied hard, it went into the negative. By close, it came back and closed at a high point of the day. But there was a fair bit of flip-flop, and all of that price action was based on comments from Jerome Powell, the Fed chair, who did not push back. It wasn't, you know, dovish, but it was not hawkish. So it was kind of left undecided. And I think this is a classic second-day reaction to events. We've seen this multiple times in response to data. This time it's in response to a speech from the Fed chair. So, you know, complete reversal from a day before yesterday's price action. NASDAQ is down 1.6, 1.7%. And we have at least, I counted 4 Fed speakers, right, who came out and basically sent the message home that rates perhaps need to be higher for longer. So we are back in that same kind of quandary about how high rates will go. By the way, the Fed terminal rate has gone up to as high as 5.2%. So that's something to ponder over. For us here, I mean, oil is the other worry, right? We had the RBI, for example, highlighting the worries with regards to inflation, core inflation, etc. Oil prices are marching up, and they're now northwards of $85 a barrel, which is not a good thing for inflation. And of course, for imports, we import 80% of the stuff. This morning, just to come back to some of the local cues, I think the big one which markets will be waiting for with bated breath is the results of the MSCI review. MSCI basically put out a statement, you know, a few hours ago, basically saying that you know, they've got a lot of feedback from market participants, etc., on the Adani Group stocks, and perhaps a lot of what is defined as free float in the case of some of the Adani Group stocks is not. And they are going to do a review. They're doing a review, and they will sort of release the results of the review later today. I think tonight maybe. So we'll watch out for that. But I think that's a pocket which will warrant close watching. Nifty yesterday closed exactly to the point. It closed exactly at the 20-day moving average. You look at the close at the bottom of the screen, 17,871, and the 20-day is 17,871. But a solid close, a little higher, I think, will do more for the bulls. And if you want to look at one more level, it's the 40-day exponential moving average, which is now at about 17,962. So, I mean, a decent close above 20, a decent close above the 40, and I think you're good to go. But will we get that with the kind of close we have? So supports are important as well. They come in at 17,650 kind of levels. Banks underperformed the Nifty. There, the 20 days at 41,701, and supports for the Bank Nifty come in at about 41,100. So it's still in a range, right? I mean, the higher the day of the budget, the lower the day of the budget. And for ever since the day of the budget, we've been kind of meandering in between the high and the low. So very, very range bound, not really breaking out or breaking lower. Even if when it looks like it's breaking higher, like yesterday, you get a session like what we had overnight, and perhaps softer cues to start the day with. SGX is indicating a 16-point higher start. Morning, guys.
Absolutely. So the SGX Nifty is trending a tad bit in the green, and you'd have to say that from the budget day low, the market has covered a bit of ground, right? The Nifty is up almost 300 points in the last 4-5 trading sessions. And yesterday as well, despite the market, of course, was higher, but you had so much participation across the board, whether it was from Reliance, from Infosys, from TCS. So a lot of large caps really made sure that the market held afloat yesterday and closed above that 17,800 level. Now, even in terms of, the FI data, the FI selling has reduced quite a bit, which is very good. FI selling has reduced to about 736 crores in trade yesterday. There was more DI buying than FI selling. So let's see if the market has bottomed out around the 17,700, 17,800 level. Of course, there's perhaps one more rate hike coming. At least that's what a lot of economists are penciling in. Morgan Stanley put out a note that they're expecting that the tone of the RBI indicates another rate hike of 25 basis points in the April meeting. So that may have some rub-off impact as well. Now, this morning, the global handover is on the weaker side across the board. There was a 1.5% cut. The headlines are not looking that great with the layoffs that have come through from Disney, the massive restructuring, cost cutting, etc. So all of that put together would have a bit of an overhang. But the Nifty for now is holding on to the budget day low and is, as Prashant was saying, the 20-day moving average is something that perhaps is already here. I'm also watching out for the 100-day moving average at 17,940, which could be the next line in the sand on the upside. The SGX Nifty is indicating a positive start. So let's see. Also, the Adani Group stocks have extended their recovery, and after all the MSCI, news flow that's coming through, maybe there could be some more of an upside there. Time will tell. But for now, things are looking stacked in favor of the bulls a bit.
Well, that's right. And it's a big day, actually, because today's weekly expiry as well that plays out. You have weak overnight cues and also the buy on dips thesis. That's going to be tested today, given that the kind of cues that we have. And keep in mind, the SGX Nifty, you compare it with the Nifty future. So actually, it's indicating a mild negative start just to kickstart trade, because the Nifty futures were a little bit higher than that level. Now, we had encouraging cues coming in from the FIs, and I'll get to that in just a bit. But the Nifty as well as the Nifty Bank, they need to get past the key technical level, which is the 20 DMA, and trade above those levels. Then you're bracing for a bit of a short covering bounce that could play out. In terms of the FI data, I say it's encouraging because just look at the institutional flows. Now, yesterday, the FI sold close to 730 crores odd. The 10-day average has been net selling more than 2,500 crores. So their selling has come down, encouraging. Second factor, the institutions, as the FI and the DI number, you put it together. Yesterday, they net bought 200 crores. The 10-day averages, normally they've been selling close to around 450 to 500 crores. And that's why you had a good day. So you don't need the FIs to buy, just need them to sell a little less. And the rest, the markets can manage. That's at least the data points that have suggested the last few days. What are the FIs doing in the FNO market? They covered shorts yesterday, close on 10,000 short contracts. They added longs, close on 4,000 long contracts is what they added. But the encouraging part for me is they wrote puts, and they wrote puts rather aggressively yesterday. Close to around 2 puts were written for every 1 call. And if things go wrong, they're also buying puts. So there is some cushion on the downside. There was clearly a short covering bounce that played out because the open interest was lower on the Nifty. So on the Nifty, you did have some bit of a short covering bounce that did play out. Moving to the options data, I was telling you that put writing was there yesterday. The 17,800 put, it added close to around 65 lakh shares. The premium out there was on an average close to around 50 rupees odd. So that's telling you that the bulls are looking to defend 17,750, and that contract expires today. After a while, we saw the calls that were written earlier, they ran for cover. So they closed out more than 60 lakh positions yesterday. Getting straight to the levels then, 17,800 put is getting written. So 17,750 becomes an important support. The resistance zone comes in that vicinity of around the 100 DMA. So we close at the 20 DMA. The 20 to 100 DMA becomes a bit of a resistance zone, both on the Nifty as well as the Nifty Bank. The Nifty Bank as well, you like to get it past 41,750 odd. The buy on dips thesis is going to be tested today. SGX Nifty suggesting a bit of a flattish to a mildly negative start. Let's see how this one goes.
Yeah, no, absolutely, Nigel. Earnings are not supportive as well, right? Yeah. I mean, I think that's the other worry. If earnings were all raging and, the global setup was a little off, etc., one could understand, one could make the case. But more often than not, I mean, I counted out of 50 companies, 30 companies which actually have seen downgrades for FY24. And earnings season is still on. So I think that is the other kind of worry which we have to kind of contend with. We don't the aggregate Nifty FY24 EPS and how much it is lower by, but 30 out of 50 have seen downgrades, and I think about 11 have seen upgrades. So this is, we'll put that data out later. We'll tell you what's lined up here over the next 30 minutes or so. First up, we'll get you an exclusive conversation with a special voice from Citi. Matt King is global market strategist at Citi Global. Our research team will get you the top 10 stocks to watch. That's coming up. And of course, Hemang Jani of Motilal Oswal Financial Services for a quick fundamental stock check.
All right, let's begin the day now with some cues coming in on the equities front. We have first up Mahesh Nandurkar of Jefferies, who says with the recent pullback, the Nifty is now trading at 18.5 times one-year forward PE, or a 7% premium to the 10-year average, and the valuation gap versus China is also now back to the 10-year average. This makes them more optimistic on the market outlook, with another 25 basis points hike. Peak rates are looking very near, which is a positive for lending NBFCs. Jefferies has added Bajaj Finance and Cholamandalam to their model portfolio and has added some weight on L&T and Reliance. They've removed ICICI Pru, Indian Hotels and Concord, and they've cut their weightage in ICICI and SBI.
Well, on the rupee, Parul Mithil Sinha of Standard Chartered says the dollar INR has seen upward pressure last week on the back of dollar strength post strong jobs data in the US. Parul expects the rupee to trade in a range of between 82.25 to 83 to the dollar next week, while the next event to watch out for is the US CPI, which will determine dollar trends and Fed rate hike expectations.
Okay, and on the bonds, Parul says domestic bond yields have seen upward pressure on global sell-off post the strong US jobs data and the hawkish rate hike from the RBI. She expects this bearish trend to continue this week as the market readjusts its positioning and absorbs the auction supply. The range for the 10-year benchmark is seen at 7.3 to 7.45%. Parul says the focus now shifts to India's CPI, where they expect to come in at 6.2%, and the US CPI will be in focus as well.
Well, we have a lot of stock-specific action to track for you, and we'll get to that in just a bit in our special Top 10 segment, where we're looking at Cummins, we're looking at JB Chemicals, Narayana, Hurudalai, and Oberoi Realty. Those are 4 stocks that could react to positive news flow. On the flip side, Adani Power, Escorts, Trent, Honeywell, Piramal Pharma, and Piramal Enterprises, they are stocks that will be reacting to negative news flow.
Okay, let's get you that exclusive chat now. I spoke with Matt King, global market strategist at Citi, on the sidelines of the India Investor Conference 2023, and began by asking Matt the outlook on inflation and how hawkish a Fed essentially will be. Is it possible that we get a bit of a Goldilocks kind of scenario, not too high inflation and a mildly okayish Fed as well? Listen in.
On the one hand, I think that I'm optimistic about inflation coming down, but the way I think about inflation is different from how the central banks think about it. They're focused on the persistent element, the services inflation, the wage growth, and that basically leaves them feeling they need to do more with the risk of holding rates too high for too long. And so to my mind, it's not really Goldilocks. It's just this mismatch between how they think about it and how I think about it. It may just justify, let's say, some further rally in the long end of bond markets, but it leaves the front ends potentially vulnerable to that more hawkish policy, and it leaves risk assets like credit and equities also more vulnerable to that hawkish policy.
Right. So, Matt, you're saying that, if I'm understanding you correctly, if they were to do a lot more, that would be a mistake?
Basically, because of the lags in the system, yes. And not only if they were to do a lot more, but even maintaining these levels of rates for an extended period, I think risks being a mistake. So the way central banks think assumes that rate changes feed through almost directly into levels of inflation. Their concern is that inflation in advanced economies is that inflation is still high. Real rates or real short rates are only just entering tight territory, and we're very worried about the persistence of inflation, about de-anchoring, and therefore, as I say, even as headline inflation starts to come down, they're focused on whatever they see as the lingering component, the sticky parts, the services inflation, the wage growth. All the things I look at in terms of money growth, they don't look at all. And when I look at, and therefore they assume this sort of momentum behind the private sector, and that this momentum risks turning into persistent inflation. Everything I look at for advanced economies shows all of these monetary aggregates going in exactly the wrong direction. And a lot of the reason for that is that the surge in money growth, which I think drove asset prices and drove inflation, unlike history, it didn't come from the private sector. It didn't come from you and me borrowing because rates were cheap. It came from the fiscal stimulus in people's bank accounts. It came from the QE that had already been turned off, basically, even before the rate hike started. And now the central banks are carrying on with the rate hikes, even as the money growth numbers are deteriorating. So yes, temporarily, people are getting excited about Goldilocks. To my mind, the risks are that the lags in the system means that this collapse in money growth still hasn't made its way through. And on the one hand, that's good news in terms of inflation coming down, but it's not enough to make the central banks go back to easing, and that in turn adds up to this risk of over-tightening.
So when markets are pricing in around a 25-30 basis point rate cut by the Fed in the last part of this year, are they getting it right, in your opinion?
I can only imagine that happening if we have let's put it this way. There is a big inconsistency between that and the whole inversion of the yield curve and the indications of recession, and then what we're pricing into credit and especially what we're pricing into equities. I can imagine the bond market being right, but only if there is a huge deterioration in the economy, a huge deterioration or fall in inflation levels. In general, the hurdle for the central banks going back to easing is way larger than it was in 2019 when they were worried about deflation risks relative to now when they're worried about persistent inflation. And basically that creates the risk that in the near term we've priced in too much of that easing, but more than anything that credit and equities end up being vulnerable as the easing that they're hoping for turns out not to happen, especially with equities at these elevated levels.
Matt, you look at sort of global central bank liquidity very closely. Give us the big numbers. What was it at, pre-COVID? How much did it get to at the peak? Where are we now? And where are we headed?
This gets complicated, especially in the details. Let me give you the summary. In general, what I find is almost exactly the opposite of what the central banks tell you. They look at the size of the balance sheets, the levels of reserves. I look at they think once it's been announced, it should be priced in. I find it's only as the flows of liquidity hit markets or are withdrawn from markets that we seem capable of pricing it in. They look at the impact through rates. I look at the impact directly in credit and equities. And basically what I see is that $1 trillion change in liquidity from the central banks over the last decade corresponds relatively directly to 10% on or off equities. So far, so straightforward. And indeed, on the most obvious measure of central bank liquidity, the securities on their balance sheets, they're planning on draining a bit more than $1 trillion of liquidity this year. And so my instinctive starting point is to think, oh, that's another minus 10% or so on equities. The complicated bit is some of the extra technicals which also have an impact on reserves and I think are ultimately what drives markets. Some of those have been supportive over the last few weeks, especially from Japan and from China, and are part of why markets have been doing better. There is a story where in principle those could continue to be supportive all through this year, especially at the Fed. I'm not fully convinced about that story.
What happens once we get through this phase where the Fed gets to pushing rates up to wherever they're comfortable with and holds them, but eventually a year down the line, you think we will go back to an era of very low interest rates, which everyone got very used to, or you think that is very tough? How do you think about that?
This is a huge and complicated debate. I am probably in a minority by thinking that we do go back to those very low levels of rates, at least temporarily. The people who think that we are likely to have more persistent inflation and higher rates tend to be emphasizing factors like deglobalization. They say the shortfall in inflation previously was because of globalization, and now under deglobalization, maybe that's running in reverse. The trouble I have with that is that it sounds plausible, but I don't think it fits the data. What to me explains most of the previous disinflation is technology, and scalable technology in particular. What every firm wants to invest in is intellectual property, is branding, is software, is doing more and generating more profits, but with fewer employees and even with less capital. And to my mind, even as we get a rotation towards things like green energy, it's that lack of desire to borrow, which I see at a global level. It's that which I think has kept things like term premium down and kept rates down. And it's that lack of private sector money growth, which I'm right, will eventually mean that the central banks get forced back into easing and that we can come back to those low rates. The main threat I see to that is on the political side. If we re-elect populist politicians at a global level and they push through time for easier fiscal policy and easier monetary policy, and there is a strong historical precedent for that, and kind of public sector debt pushes up pushes up interest rates, then that can turn things around. But just temporarily, we've seen it in the UK. The bond market really didn't like it, and I think other people will be hesitant to go down that route. But that would be the longer term risk to my mind. But it's all about this balance between technology on the one hand and then globalization, and people don't really have a clear view of which of the two is dominant.
All right, that is the macro picture, but let's slip into a quick break. Lots of stocks in focus, so don't go anywhere. We'll be back with the list of top 10 stocks in just minutes from now. Stay with us. Okay, it's a brand new day and there's plenty to talk about. So many stocks on our radar. First up, we have our entire research team is joining in, so let's welcome them on board. Good morning, folks. There are some very interesting changes that have taken place. The MSCI review has come through of the Adani Group, and of course, there's the Q3 numbers of Adani Power as well. As always, Vivek is here to give us a lowdown on all of that. Vivek, over to you.
Well, good morning. So on Jan 28, keeping in line with the heavy news flow as well as the volatility seen in the share prices of the Adani Group stocks, MSCI had invited feedback from market participants as well as the members to actually give feedback on the treatment of Adani Group stocks within the MSCI indices. So today, today is also the day post-market hours. Today, you're expecting the results of the MSCI India Index review. So what MSCI said is that they would now be, after getting the feedback, they would now be reviewing the treatment. And as per analysts, they expect the weightage of Adani Group stocks that are present in the MSCI Global Standard Index to be reduced. Now, why is this important and what is the quantum? Remember, all of the Adani Group stocks, barring Adani Wilmar as well as NDTV, are part of the MSCI Global Standard Index. And on Jan 28, the weightage of all of these stocks was quite significant. So you will be expecting an impact, especially if there is a weight reduction happening through. Which are the three stocks that have the maximum weightage? Adani Enterprises, Adani Total Gas, as well as Adani Transmissions are the stocks that have the highest weightage from the Adani Group, the MSCI Global Standard Index. And as you mentioned, Adani Power will also remain in focus on the back of slightly muted results that the company gave post-market hours yesterday.
Okay, all right, Vivek, thanks a lot for that. Well, Sonia, in the final minutes of trade, actually, we got the numbers of escorts. They looked a little disappointing on the margin front. Oh, absolutely. It's the third quarter now of disappointing numbers from escorts, and I expect the stock to be deep in the red today. Very weak margin performance coming through. It's a 560 basis points knockdown in margins at 8.3%. And in the main segment, which is their farm equipment or their tractor segment, the margins have fallen to 8.3 versus 15% same time last year. Now, the company in their press release says that the fall in margins is because of A, unabsorbed commodity price inflation, and B, delayed price hikes. So all of that put together has hit their margins. They say that inflation impact may take some time to normalize. So perhaps even in Q4, they could see a hit over there. The net profits were also hit by an exceptional item of 53 crores due to impairment of an investment in the JV Tadano Escorts. So all in all, I'm going with red. Revenue growth was not too bad, actually, 15% growth over there. But it's really the operational performance which has gotten hit. As you can see on your screen, EBITDA down over 30%. And the agri-machinery segment has been hit very hard as well. So going with red. But let's go across to Mangalam to find out how Trent's numbers look this time. Mangalam.
Well, you spoke about an operational miss in escorts. I would say the same for Trent as well. Revenue growth, no problem. In fact, the company has reported its highest ever quarterly revenue year on year on a low base as well. We've seen a 54% jump in the company's top line. However, gross margins have contracted by about 300 basis points. Remember, there were rent waivers, etc. last year. Now they have to go ahead and pay the full rent and increased operational expenses as well, as a result of which margins have compressed by 430 basis points and the net profit has been impacted. However, what supported the net profit is other income coming in at 61 crores versus 30 odd crores. West side, out there, we saw 17% same-store sales growth. That's good. However, Jeffrey says concerns persist around margins, urban slowdown, as well as valuations. And as a result of which, they have a hold rating on the stock with a target price of 1400. Because of valuations and margin concerns, I'm going with the red.
All right, Mangalam, thanks very much for that. Now, Cummins and Honeywell are the next two stocks on our radar. Vahishta is here with more. Vahishta, hi, morning.
Hi, good morning, Prashant. Let me start off with Cummins. Excellent set of numbers coming. In fact, the company has reported a record quarterly performance, which is driven by a strong domestic as well as their export revenues. Now, if I do an analysis of just the basic numbers, the revenues have come in at approximately 2,100 crores, which are 12% above the estimates. Also, the margins have jumped 330 basis points, which is above the estimates. The export revenues are higher by 23% on a year-on-year basis, while the domestic sales are better off by 27% on a year-on-year basis for Q3. The company has said that the demand momentum which was witnessed in the earlier quarters have continued even in this quarter. Also, there is a strong demand from the end markets like data centers, from healthcare, from infra, from the commercial real estate, etc. In terms of outlook as well, the company is quite optimistic, and hence I'm going with a bright green on the stock for today. But the next stock, which had also released their numbers yesterday post-market, was, as you mentioned, was Honeywell Automation, wherein the numbers have been a mixed bag. The revenues have jumped by 18%, by margins have fallen to 12.8%, which is the lowest in the past 3 years, which is also below Nomura's estimates of 18%. Now, this comes in as a major surprise, despite a sharper than expected ramp up in sales. I'm going with a red on the stock.
Yeah, indeed. Honeywell, those margins are disappointing, though there's a ramp up on the sales number. Let's see how that one reacts. Should be in the red today. But let's hop across to Ekta. She's joining in to tell us about a few pharma-related stocks. Morning, Ekta.
Thanks for that. I'll start with Piramal Pharma. It's a clear disappointment which has come through for Piramal Pharma. They have approved a rights issue of around 1,050 crores, but just look at the numbers. Revenue is up 11.5% year on year, but the margins have come down to 5.1% versus 14.7% on a year-on-year basis. Loss of 90 crores versus a profit of over 160 crores. And on a Q-on-Q basis also, the margins have halved by around 500 basis points, and the loss has widened as well. So clear red on Piramal Pharma today. JB Chemicals, I expect that stock to be in the green. Revenue up 32%, margins have improved marginally, and a profit of around 26% in terms of a growth. Domestic formulations was up 42%. Even if you exclude the acquisitions, it was up in mid-teens. Contract manufacturing business crossed 300 crores for 9 months. Narayana Health, strong performance. Expect the stock to be in the green. Revenue up 17.5%. Margins have improved year on year as well as Q on Q. And the profit of 153 crores compares to 97 crores on a year on year basis.
All right, thanks a lot for that. Well, those are a whole host of stocks. But let's find out the latest on Oberoi Realty. Sonal has the data for us. Sonal, how did it look?
Well, as far as the reported numbers are concerned, they were aided by their rental income and mall income as well. So if you look at the P&L, revenues were up 96%, EBITDA was up 183%. Margins also, they expanded considerably to 57.7%, leading to a profit growth of 50%. And as I said, it was aided by their mall revenue and hospitality revenues as well. Some revenue coming in from the commercial segment. However, if we look at the residential segment, that did see a decline. We had reported it earlier as well. Area booked was down 65% on a YY basis. Value was down 67% on a YY basis. So yes, the residential segment did not do well. The outlook, however, in terms of launches is very positive. So on the back of that, the stock will be in focus today.
Okay, all right. Sonal, thanks a lot for that. Well, Abhishek joins us to tell us about Piramal Enterprises. Abhishek, disappointing set of numbers yet again?
Well, the numbers are all over the place and very, very difficult to understand. How can a gross NPA in absolute value rise by 93% quarter on quarter and the gross NPA ratio rise by only 30 basis point quarter on quarter is a phenomenon that I have not seen across any lender. So AUM growth is just 1.7% quarter on quarter. They had a disbursement of 5,100 crore, but the AUM growth is only about 1,100 crore. The revenue is down 7.5%. Despite that, the net interest income or the net interest interest margin as well has seen growth both YOY and quarter-on-quarter. So it's the cost of funds which has actually aided this time around. Tax write-back of 3,432 crores has helped in their profitability. So profit after tax is at 3,545 crore, which compares to a loss of about 1,537 crore in the previous quarter. As I said, gross NPA value-wise has increased by almost 93% quarter-on-quarter. However, the ratio, the gross NPA ratio is at just 4% versus 3.7% in the previous quarter. They have also written in their PPT that they have written off NPAs worth 771 crore in this quarter, and they have one non-RE, that is non-real estate player exposure of about 1,900 crore. 1,255 crore has not been categorized as NPA, and they are looking to resolve that. So stress has actually built up in Piramal Enterprise financial side. Back to you.
Okay, well, strange things happen, right, these days. Thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow today. There's Cummins India, JB Chemicals, Narayana Hrudayalaya and Oberoi Realty, while stocks with negative news flow, Adani Group, all the Adani Group stocks, Escorts, Kubota, Trent, Honeywell, Piramal Pharma and Piramal Enterprises. But the other big headline we're tracking is what's happening in the world of crude, because it's been 3 days running now that crude has been moving up. Brent crude, in fact, is now at $85 a barrel plus. Manisha Gupta is here to give us more of all the action there. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, yes, absolutely. After 7% of decline in the previous week, this week we've seen prices gain up by almost 6.5% already, and $85 per barrel is holding. The markets are looking at the U.S. crude stocks, which have continued to rise for a 7th straight week. Now we are at 2020 high, so that is what is keeping the prices in check. But on the other side, the demand estimates are clearly on the higher side. With Saudi Arabia hiking Asia market prices for the first time in 6 months, tells you that the demand is coming back. There are higher demand estimates coming in from China, and then there are supply concerns from Turkey still on the suspended operations at Ceyhan. Also, BP's Azerbaijan now has declared force majeure on Azeri crude shipments. That also adds to the premium. There is a shutdown on oil field in Norway. So various of these supply concerns are keeping the prices higher. The markets will now watch out for the China's CPI data that's releasing tomorrow, and the markets are anticipating a 2.2% of number on that.
All right. We'll take a quick break here, Manisha. Thank you very much for that. Up next, Hemang Jani of Motilal Oswal Financial Services will join in for some fundamental stock talk. Later, we'll also connect with Abhishek Somany of Somany Ceramics to discuss their results. Stay tuned. All of that coming up.
Welcome back. We have about half an hour to go before the pre-opening rates kick in. Today's a big day of earnings as well. You have the likes of Aurobindo Pharma, the standalone numbers of Hindalco, there's HPCL, there's IRCTC, Lupin, a lot of companies reporting their numbers. So we'll track all of that very closely for you. For now, the SGX Nifty is indicating the start will be in the green. Hemang Jani, who is the retail equity strategist at Motilal Oswal Financial Services, joins us now to talk about what his view is on the markets. Hemang, the big question everyone's asking is, are the new age tech companies getting back to profitability? We saw part of it with Paytm, but now the next perhaps is Zomato's turn. Tell me, are you buying any of these names, Paytm, Zomato, PB Fintech?
Yeah, good morning, Sonia. I think having seen a major rout in the last few months, we are seeing some stability in the stock prices. Also, if you look at the management commentary, they are saying what the market likes to hear, in terms of profitability, coming back much sooner than what the market was expecting. Also, the numbers in terms of operating, matrices are looking much better in the past few months. So I think from a tactical, trading perspective, we do see, names like Paytm and Zomato providing, some opportunity of 15-20%. But beyond that, it will be very difficult to gauge, because we all know that the interest in such names comes back and goes off very quickly if there is any disappointment on the numbers or the overall growth. But we do think that large part of the pain is behind. Yet there are some investors who are looking to sell. So there might be at some point, some selling that can come through. But at this point, given the recent developments in the management community, there is a case for some upside.
Okay, there's a case for some upside. What about a couple of these real estate stocks? They've done pretty well. I mean, Oberoi Realty has reported really good set of numbers, and we all know the kind of boom that's happening in the real estate space right now, especially in metros. Would you buy any of these names like Oberoi Realty?
So Sonia, we have been quite positive on the sector, and our preferred picks have been Lodha and some of the Bangalore-based companies like Prestige and Brigade. I think partly because of the way the interest rates have really gone up, the overall interest level for the real estate stocks has come off. But given the fact that there is a momentum in the new registrations and the overall growth visibility is very high from the recent management commentary, we would have a positive view on the names that we have discussed. Oberoi also is something that we've been liking.
All right, Hemang, request you to stay with us. Talking about real estate, let's focus on a couple of ceramics companies. And Somany Ceramics, they posted a weak set of numbers with tepid volume growth of close to around 14%, keeping the top line muted. The margins as well have contracted on a year-on-year basis, but the hope is that going ahead, there'll be an improvement in margins. And the hope is that volumes as well will pick up. To understand that and more, we're joined by Abhishek Somany, the MD and CEO at Somany Ceramics. Hi, Abhishek. Good morning. Always good hearing your thoughts. Let's address a couple of factors. One is, how is demand shaping up? And can you achieve that full year volume guidance, I think of around 66 to around 68 MSM? Is that still on the cards? And what about margins? They are in that vicinity of around 7%. But since volumes are picking up and input costs are cooling off, can they improve from here on? Go ahead.
Yes, so margins, the volume has been a little muted, at least in the quarter three. Quarter one, quarter two also weren't the best. So I don't think we would be able to match the kind of projections we had made, but we'd be somewhere there. It won't be too much off, is what we think. Hopefully, Jan, Feb, March should be better. Margins, that there has been the gas prices, which is the biggest hit in the margins, have started coming off. But the real value of that will start being seen only in the next quarter, because gas is a moving average, and we've seen it coming off only in January.
Abhishek, looking for a couple of numbers on both those two aspects. One is, you won't be at 66 MSM. So what do you end with? A 5% miss? Will you end closer to around 63 MSM? Is that possible, or is it going to be a little bit lower? And margins will improve by how much? By 100 basis points, 150 basis points? Give us a broad margin band. Go ahead.
Yeah, so I think it'll be more than the volume number which you just mentioned. We should be slightly more than that, so it won't be that big a miss. But on the margins, as I could hear even earlier in this news channel, that the oil volatility is huge. So that is something I can't give you a forward-looking statement, but definitely the oil prices, the gas prices for us are lower than what it was last quarter. But coupled with that, it is quarter four, and the demand is a little muted. Therefore, there would be a slight bit of schemes which we will give to the dealers, a little bit of discounts which we would give to the dealers for the offtake. So maybe a little bit of that may be passed on. So I will not be able to give you any forward-looking statement as to what the increase or what the addition would be on the margins, but there definitely would be an addition, because volumes will be up and the input price is also slightly lower.
Right. Abhishek, hi, good morning. Prashant here. So how is the overall demand scenario underlying? Is it weakening? Is it strengthening? What are you seeing? We had, for example, we spoke with companies like Prince Pipes yesterday, who spoke to us about, and their view is that construction, real estate, etc. is doing very well. We spoke with Astral, yesterday again. Their view is that things are looking strong. But I just want to understand from you, what's your sense?
Yeah, so I think in our industry, there are two segments. There is one which is the retail, and the other one is the projects. As far as projects, which you talked about, real estate numbers of Oberoi and various other companies which have done very well. So I think those numbers only kick in for tile industries 15 to 18 months down, because we're the last in the chain to get consumed. So that's as far as project is concerned. And we're looking at a huge upturn in real estate. So bracing for a great future. Now comes to retail. In the retail, we sell through dealers. Because the fuel prices had gone up so sharply, and now it is coming off, the dealers are also a little tentative to stock up. So the stock in the channel is very little. They're wondering how much more the price will fall down. Although I don't see the prices falling down very much. in other than the small schemes, 1.5%, which we would get. So I think they're tentative, and therefore there's been a little bit of destocking. Other than that, in the northern and various other parts of the country, there's been a huge festive seasons, marriages, etc., plus the winter. So Q3 has been a little tepid. Other than that, the export also took a beating in Q3, although it is up from Q2, but not as much as we thought it would be. Again, because Europe has just come back on to start taking material. So I see a large export uptake from Morbi, the cluster where tiles are produced, which means that the demand for the branded segment would only go up in the future as a lot of their material would start getting exported. We're looking, currently the export is approximately 1,300 crore rupees month, up from about 1,100 crore rupees, and we see this going up to about 1,500, 1,600 crore rupees per month for next year.
Sure. Okay. It's interesting that you point out that in the retail segment, the growth is looking very strong, especially, from a lot of real estate players. So you have a capacity, a capex expansion project across 3 regions that you've completed now. You have, I think, 73 MSM tiles manufacturing capacity. Would you look to expand any further, or is this it in terms of capex plans for the next year?
Very right. If you've seen in the last results, we have capacity utilization is about 87%. So most of the capacity we put in have gone on stream. We are currently doing another expansion of 4 million standard cubic meter, 4 million square meters of tiles, which will be up and running around mid next year, financial year. So about September, October is when we see that coming on. That's for the big slab tiles. It's a state-of-the-art Continua Plus plant. So that's going to be happening sometime mid next year.
And very quickly, do you want to give us that sanitary ware business? I think you were expecting it to scale closer to around 300 crores. Is that on the cards?
Yes, so we would be anywhere between 275 and 300 crores. Again, off by the same kind of percentages. But there we are looking at a very strong next year, because the built-in capacity for bath fittings and for sanitary ware would be in place.
So 275 crores will be this year in FY23?
Yeah, correct. Somewhere there.
And next year will be even better. So you can scale maybe higher. Approximately what number should we look at?
I think we should be looking at between a 20-30% growth because it's a small base.
Okay. All right. Thanks so much, Abhishek, for stopping by and giving us those details. Looking forward to having a chat with you sometime during the quarter yet again. For the time being, we'll slip into a short break, but let me tell you what's lined up for the next half hour of the show. On the other side, Anuj Singhal will be joining in for a quick trade setup. Post that, we'll also bring you the top stock picks for the day from our technical as well as an F&O experts. And before market opens in a CNBC-TV18 stocks board, we will highlight the top stocks in news to focus for the day.
Welcome back. Well, we're counting down to the pre-opening rates, and you know what? The market is indicating that perhaps there could be some more of an upside. The SGX Nifty is up 24 points. In any case, there's been short covering that we've seen in the Nifty in the last few days, and now FI selling is also reduced. Anuj is joining in, but he's not in Mumbai, he's in Delhi. So let's get a viewpoint on what's happening there. Anuj, hi, morning. What takes you to Delhi, and what's the view on the index?
Well, what takes me to Delhi, of course, is a combination of work, but more importantly, good weather, because the peak winter is behind, and this is actually the best time to be in Delhi and to enjoy and to, move out of Mumbai, which is where, the best of the weather is behind us, I would say. But talking about the market, Sonia, as you pointed out, we had good short covering. The Nifty managed to close above 17,850. But there's weekly expiry today, so there could be some volatility. And there's this Adani factor as well, this MSCI factor. So I would want to see how the Bank Nifty moves, though off late it's sort of negated that impact. Globally, of course, NASDAQ was down because of this Google impact and a couple of statements from the Fed governors. But I think the market would still give a benefit of doubt, given how dollar index and the bond yields have behaved. My only worry about the market, though, is on the technicals, because we are right at the 20-day moving average on the Nifty, 20-day simple and exponential moving average. And last time when we had a 20-day moving average halt, and this is a declining 20-day moving average, Nifty fell 600 points. Now, I'm not suggesting we fall 600 points, but there's a risk if we have a 20-day moving average halt. So I would want to see if we negate that and manage to close above 17 900, 950. I think that would soothe some nerves. On the bank Nifty also, we are right in between two very important moving averages, the 10-day exponential moving average and the 20-day exponential moving average. And there's some sign of fatigue, especially yesterday if you see the chart of the bank Nifty. So let's see. Purely from the risk-reward point of view, my sense is today might not be the best day to go long, given its weekly expiry as well.
Anuj, enjoy your stay, and after this, check your phone. I sent you a message with my food order.
Chole bhature.
I'm wondering what winter we had in Bombay.
I remember that.
Right? There was absolutely no winter in Bombay, Anuj, just barely for 1 or 2 weeks. So I'm glad you're getting to enjoy some of it there. But
Anuj, if I had to message you, you know what my order will be from that part of the world.
Absolutely.
It won't be food.
Don't worry about that.
All right, guys. Anuj, thanks very much.
I just need to check how much is allowed to be carried. Yeah, thank you. I was just saying that, Thank you so much.
All right. Thanks very much, Anuj. Appreciate it. Well, that's
what
the setup.
is it that you get in Delhi that you don't get in Bombay?
I think I have an idea.
Certain things are relatively cheaper out there, and certain things are relatively tastier out there. So I think Prashant's going for the tasty option, and
that's pretty clear.
And you're going for the cheaper one.
I think we're clear on what.
All right, Anuj, have a good one. Thanks a lot for joining in. Well, Sudarshan Sukhani of Technical Trends and Mitesh Thakkar of Earning Waves is also with us. So let's get a view from them. Sudarshan, good morning. Do you think this pullback that we've seen, the short covering rally, is something that can perhaps extend itself? And if yes, what are the stocks to look at?
Good morning. See, Sonia, the signs are that it will extend itself, which means that we should look at higher levels. The problem is that this entire rally is coming in a very choppy fashion. It's not giving us, day by day of gains. It goes up, comes down. Intraday traders have a very difficult time catching it. But overall, there are gains every day. So the trade really is to take a position in the Nifty, a long position, and keep it for a few days. Your stop should be 17,650 because the intraday, nothing is coming out. But if you carry these positions in 2 or 3 days, one day you get a big gap like yesterday, and that covers up. So be long in the Nifty, expect higher levels. Don't look at intraday, but rather carry the positions forward. And the Bank Nifty is a no trade.
Okay, all right. And Sudarshan, this positive view gets negated when the Nifty breaks what level on the downside? Where's the support?
17,650.
17,650. Got that. Mitesh, what about you? How are you feeling this morning in terms of an index trade? Are you feeling bullish, or do you believe we could see a bit of a slide?
Morning, we've been maintaining a positive bias since day before yesterday. And it was only yesterday that the market picked up and started moving on the upside. My sense is that I think we should, in the short term, be positively biased, head towards 17,980, 18,000 in a good case scenario, even 18,100, 18,150. So I think these are the levels which we are watching on the upside. That's where we would want to take profits. But on stock side, I think clearly we were trading with long bias. And yesterday we had 3 longs to a sell. Today we have all buy calls. So I think very clearly the short-term traction looks more to be on the upside.
Okay. All right. What about individual stocks?
So I have all buy calls, as I mentioned. Lupin is a buy, though it's got numbers to be announced. I think the setup is looking very positive. So buy with a stop at 763 here. The first target on the upside would be 805, maybe even higher levels in case something positive comes out. IGL and the gas stocks were buzzing yesterday. IGL is a buy. Keep a stop just below levels of 430 for targets of 450. And Cummins is a buy as well. I think the numbers were very good. The setup, the positive chart setup in the short term should suggest more upside. So 1455 or just below that should be the stop loss. 1525 is the target. And finally, a buy on Reliance after a long time. It's just giving signs of reversal, but it needs to clear the intraday pivot of 2360. It's just trading below that. So buy about 2360. Take a 20-point stop loss, say 2340, and 2405 should be the first target.
Sudarshan, what about you? What are your picks?
Well, Apollo Hospital had a decline of almost 20% in just 2 months, and that's a lot for a blue chip company. That decline seems to be coming to an end, so we are really buying Apollo Hospitals on a dip, a sharp correction. That seems to be over, so buy Apollo Hospitals with a stop under 4,300. Similarly, Dabur is my only intraday short. Dabur has been, an underperformer, to say the least. It's an intraday short with a stop above 537. JK Synthetics, another story like Apollo Hospitals, big decline, almost 25% decline. That decline seems to be getting over. Now we want to buy this and find whether we are really buying at the lows, stop under 26.42. And finally, REC. Remember, REC is also becoming ex-dividend today. So that decline, if the gap down which we'll see today is not a decline, it's just ex-dividend, buy that ex-dividend stock and keep a stop under 119. Actually, it will have to be adjusted for the dividend. It should be 115 and then stay with it.
Okay, all right. Thanks a lot, Sudarshan, as well as Mitesh. For the time being, we'll slip into a short break. When you come back, we'll get you pre-open rates. We'll also get chatting with Naveen Sahadev, Director at Nuvuma Institutional Equities, to discuss all that's happening in this cement space.